Hello everyone, and thank you for joining us on our second quarter of 2023 portfolio update. My name is Cody Hines and I will be your host today. I'm a managing partner and chief investment officer here at Arrowhead Wealth Partners. Today we're going to go through a few slides that highlight our current views on portfolio allocation. Throughout the presentation you may have questions about the slides as well as your own personal accounts. With any of those questions, we encourage you to reach out to our office via telephone or send us an email and we will be glad to get back to you with an answer. With that, let's go ahead and get started. First up, I want to take a little bit of time to discuss our views on the equity markets as it relates to our current market cycle. So far this year, equity markets have produced a positive return for the most part, with the leaders in return being the growth stocks that were battered and bruised back in 2022, caused by rising interest rates from the Federal Reserve. Throughout this most recent rally, we remain in a defensive posture with a focus on quality for our equity holdings and a slight overweight to fixed income. We made a recent shift away from a concentration of healthcare sectors in favor of diversifying throughout the broader market based on potential headwinds for the sector moving forward in 2023. The chart here provided by the Wall Street Journal illustrates the equity risk premium for the S&P 500. The risk premium is how much more you are compensated for investing in the equity market compared to owning bonds issued by the US government. Based on this chart, equities have not been this unattractive in quite some time. We believe that right now, staying in a defensive position still allows us for the opportunity for potential returns without having to take on excess risk amid the economic uncertainty we're currently seeing. This chart provided by PGIM Investments shows the historical returns of different types of bonds and the S&P 500 following an inverted yield curve. The yield curve is a graph where the yield of Treasury securities are plotted against the length of time they have until they reach maturity. The yield curve becomes inverted when shorter-term bonds are paying more than longer-term bonds. This means that investors are getting paid more for taking on less risk than they are taking on more risk. This is opposite the traditional yield curve. Now we remain cautious on equities and remain a slight overweight to fixed income. High-quality fixed income is fresh off of its worst year in history and holds the ability to pay a potential attractive yield. Equities, in our belief, have priced in a sizable rate cut by the end of 2023. In our view, that seems optimistic. As Federal Reserve monetary policy evolves, we will continue to evaluate the potential risks that fluctuating interest rates pose. Recently, we have seen more and more news about the current state of the US dollar. Although we do not expect the US dollar to lose its spot as the reserve currency of the globe, we do see a trend in that the US dollar is continuing to decline after a long period of strength. Here are a few charts provided by JP Morgan Asset Management. The chart on the left illustrates the value of the US dollar, where you will see the downward trend that started last September. On the top right-hand chart, you will see the pressure on the US dollar caused by having a long-standing trade deficit. The trade deficit has caused pressure on the US dollar for quite some time. This has not been an issue in recent times, as the US dollar has stayed strong over that period of time. Now that we have seen persistent weakness, the pressure is starting to take effect. The bottom right-hand chart illustrates the attractiveness of US Treasuries versus other international government debt. As yields come down on the US Treasury and make US bonds less attractive, you see other countries' debt become more attractive and add further downward pressure to the US dollar. Because of this, we added a position in the gold sector in the first quarter of 2023, and moving forward, we have added more developed international exposure into our portfolios as well. International equities have lagged US equities in terms of performance since just before the Great Financial Crisis back in 2008. Since then, we've seen a resilient US dollar and innovations in sectors that have added to the large outperformance of the US over that time. International valuations is a drum that has been beaten by institutions for quite some time. So why now? Now that we are seeing a continuous decline in the US dollar, along with international valuations being at a discount relative to US companies, we believe that adding international exposure is a potential for opportunity for diversification within portfolios. Now, we do hold an emphasis on larger, more established companies in established countries as opposed to smaller companies in countries with weaker economies. Here are two charts provided by JP Morgan Asset Management. On the left, you will see as of March 31st of 2023, there is a 29.2% discount on average for international equities compared to US equities. On the right, you will see the difference in the amount of dividend yield paid out by international equities compared to US equities. International equities are typically more concentrated in sectors that focus on paying a dividend to shareholders as opposed to share price growth. This has become especially important as inflation globally has reached a level not seen in decades. On behalf of the entire Arrowhead Wealth Partners team, we want to thank you again for joining us on the presentation today. If you have any questions about anything that was discussed or questions about your own personal situation and portfolio, please do not hesitate to reach out to us and we'll be more than happy to help. Follow us on social media to keep up to date on what's going on over here at Arrowhead Wealth Partners, as well as current events that may affect you and your situation. If you enjoyed these presentations, you can also subscribe to our YouTube channel to get a notification about when a new video is posted. If you want to learn more about us, please visit our website to find additional information. Thank you again for joining us, and we look forward to talking to you soon.